HSA and FSA are both accounts that let you pay for healthcare with pre-tax money. Here's the difference. Simply,
I'm Maya. HSA and FSA both let you pay for healthcare with pre-tax money. And today, we'll make the difference simple.
To open an HSA, you must be enrolled in a high-deductible health plan called an HDHP. No HDHP, no HSA.
For 2026, you can contribute up to $4,400 to an HSA if you have self-only coverage. That limit is set each year by the IRS. With family coverage, the 2026 HSA limit is $8,750, plus an extra $1,000 catch-up if you're 55 or older. These are IRS-set limits.
Money in an HSA is yours. It rolls over year to year and goes with you if you change jobs. It's portable.
an FSA is set up through your employer, and it's usually use it or lose it. Money left at year-end may be forfeited.
For 2026, you can contribute up to $3,400 to an FSA. That's the IRS salary reduction limit.
Some plans let you carry over leftover funds. For 2026, the carryover limit is $680 if your employer's plan allows it. So the big difference: an HSA needs a high-deductible plan, rolls over, and travels with you. An FSA is tied to your job and mostly use it or lose it.
One important catch: if you have a general-purpose FSA, you usually can't contribute to an HSA that same year. A limited-purpose FSA is the workaround. Quick recap. HSA and FSA both use pre-tax dollars, but they work differently.
HSA needs an HDHP, rolls over, and is portable, with 2026 limits of $4,400 self or $8,750 family.
FSA is employer-based and mostly use it or lose it, with a 2026 limit of $3,400 and a $680 carryover option.
I'm Maya. If this helped, hit subscribe, and I'll see you in the next one. Let's make insurance simple.